Hello, I'm called Jingonelli and I'm going to be taking you through financing decision. And before I begin off, I'm going to require you to subscribe and also follow what I'm pointing at because I'm already having laid down information. So beginning, I would like to hint on the four major decisions in financial management. We are having the financing decision, which we are going to look at today, the investment decision, working capital management decision, and also the dividends decision. So beginning of the financing decision. So the financing decision is concerned with the selection of sources of funds to meet the investment requirements, or the financing decision is concerned with the assessment of the various sources of funds to determine the cost-effective source of financing. The financing decision is concerned with two major decisions. That is, where should the funds be raised from? Two, what proportion of the total pool of funds should each source take? Then there are two broad sources of funds, i.e., we're having the debt and the equity. Now with the debt, it can be short-term borrowing or long-term borrowing. So with debt is raised from outsiders. Equity is raised from owners of the business. When funds are raised from equity and debt, a firm creates what is known as the financing mix, which will determine the financing risk to the business. So here, what is the financing risk? Financing risk is the likelihood of the variability in the return as a result of the method of financing used by the firm. So when debt financing is introduced in the organization's financing mix, we create what is known as leverage. So what is meant by financing leverage? Financing leverage refers to the use of debt as a source of financing alongside equity funds by a firm. Or you can say it is the use of debt alongside equity. So with the financing decision, we get to look at what is a financial structure. So a financial structure refers to the balance between all the company's liabilities and its equities. Like from the accounting equation, we get to have the assets equaling to the liabilities plus the equity or the equities. So the total of liabilities and the total of equities comprises of what we call the financial structure. So financial structure equals the short-term borrowing plus the long-term borrowing plus equity. So looking at the capital structure, for it refers to the makeup of a firm's capitalization. So this can be like a combination of the different long-term sources. So it represents the mixture of different sources of long-term funds such as equity, shares, preference shares, long-term loans, retained earnings, etc. So looking at the capital structure, for the capital structure is equal to the long-term borrowing plus the equity. So therefore the capital structure is a subcomponent of the financial structure of the firm. So the financing decision is also referred to as the capital structure decision, and this is because in the financing decision we look at the specific mixture of the long-term borrowing plus the equity the firm uses to finance its operations, just like the capital structure. So you, after knowing this, under the financing decision, a finance manager has to plan the most appropriate mix of the long-term sources of funds so as to minimize the cost of capital. So with cost of capital is the same as the RRR, which is the required rate of return. So below I'm having an illustration to explain more of the financing decision. So as a manager, financial manager, when you're required to raise funds for a particular firm, for example 100 million, and you're being exposed to various long-term sources, for example dividends, equity shares, preference shares for this illustration. So you have to create what we call a capital structure. With you creating the capital structure, you're having three options out of the long-term sources. So you're having equity shares and preference shares only to raise the 100 million, And they're also having another option 2 of equity shares and dividends only to raise the 100 million. And they're also having another option whereby you can combine the equity shares, preference shares, and dividends to raise the 100 million. Now, with this, after creating the capital structures from the 3 options, you have to choose the most appropriate, which minimizes the cost of capital. So from all these 3, you'll hint back on the cost of capital videos of how we calculate cost of capital. So the one which gives you the minimum cost of capital will be best fit to raise the 100 million for the farm. So make sure you look at the cost of capital videos. Thank you so much for watching. Make sure you subscribe.